Hey, this is Robbie Cannon, CEO and President of Horizon Investments. Thank you for joining us for our Q3 2019 quarterly market review. Today with me, our Chief Investment Officer, Scott Ladner, and we're also pleased to have with us one of our senior analysts, Austin Fitch. This has been a really busy time, probably for both of us in regards to conference season, whether you're at a national event, an OSJ meeting, or perhaps even a custodial event. It's been a real pleasure to be in front of you at one of those. And you should also know that I've been very busy as well, writing, and you know that you can get my opinions on my LinkedIn page. And this time it's been about the value of advice. I've been out talking and writing about the importance of financial advice in regards to the time that we're in now. I just have never seen a more important time to be a financial advisor. And you know, from Horizon's perspective, we are a goals-based investment management firm. And what that means to us is we look at the wealth curve. So we look at accumulation, preservation, and distribution in a very different way, perhaps, than the rest of the industry, because we're centered around the individual. That said, today's quarterly review will center around three issues, and serious issues, as it were, in regards to U.S. Growth prospects and the economy. Talk a little bit about this idea of the fear of recession that's been in all the news. We'll talk about certainly U.S. politics in regards to Trump's prospects for 2020, as well as perhaps Bernie Sanders and Elizabeth Warren, and certainly we'll end with U.S. foreign policy, specifically in regards to our policy towards China and tariffs. So that said, I want to transition into this idea of the inverted yield curve. As everyone has probably heard in the news, the yield curve is inverted, and that typically precedes a recession. But Scott, I think we have some interesting news on that.
Yeah, I mean, it is interesting because we field all sorts of questions about this topic. You know, people in the financial press have been talking about it. I'm sure your clients have been asking you about it. Hey, we've got a yield curve inversion. Doesn't a recession always follow? And it is true that in prior recessions, we have had inverted yield curves that have preceded them. But it's really important to understand the dynamics of why a yield curve inverts in the first place, in order to figure out what information is included and contained inside of that. And so what we did is we did a little analysis, and we said, listen, what are the characteristics of a yield curve inversion which are consistent with predicting a recession? So, it is in fact the case that yield curve inversions that have preceded recessions have something in common. And that is the fact that the way that the yield curve inverts is from the short end, or the short-term interest rate, going up through the long-term interest rate. So it really comes from the short end rising a lot more than the long end. And this graph here, you can see that's depicted by the blue bars. What that really is a proxy for is the Fed over tightening. So the Fed really controls the short end of the yield curve, and so the recessions that have followed yield curve inversions as a result of the Fed over tightening, that has typically been the case. This time around, though, we really have not seen that. The Fed is obviously not tightening right now; they're in easing mode right now, and this yield curve inversion came from long end rates falling down through short end rates. It's a really different dynamic and a very different sort of interpretation, and there's a reason for that. The main reason why long end rates came down through short end rates really has a lot more to do with supply and demand than it does having anything to do with the Fed or with even growth prospects. A supply demand story of yield curve inversion has historically had a very different interpretation than a Fed over tightening story. And so what we see here is just the amount of sovereign debt which has a negative yield on it. And you can see, just if you have to put a dollar somewhere in sovereign debt, if you're a pension, global pension fund or a sovereign wealth fund or somebody else that just needs to have a liability-driven sort of investment paradigm, which has trillions of dollars associated with it, you have to invest in bonds somewhere. And given the choice on the screen here, where would you like to, what kind of bond would you like to buy? And many of them, many institutions are choosing the United States, because not only do we have the highest yield in the developed world, or largely even in some emerging worlds, we also have a stable and rising currency. So it's been really a winner on two fronts. And the dynamics that have driven this yield curve inversion are a lot more about the supply and demand dynamics associated with just the United States Treasury debt being very attractive for a bunch of different reasons, and it really has been for any sort of recessionary fear reasons.
Well, I mean, when we talk about this time it's different, what's interesting to me, Austin, as we bring you in, is at least this time it's not different in regards to this idea of there's a recessionary fear.
Now that's absolutely right, Robbie. And I think what we've seen, and you have probably seen it as well, whether it's CNBC, the Wall Street Journal, really the financial press as a whole has done a really good job of using those recessionary fears to really drive readership, right? And what you're looking at in this chart is the ability that we have to search for recessionary topics within news counts. And what you'll see is you've seen a spike during the third quarter to levels that we hadn't seen since 2011. And remember what was happening in 2011? That was when U.S. debt was being downgraded really for the first time ever. And there were fears, pretty significant fears at the time, around what that meant for the U.S. economy, obviously coming off the back of the great financial crisis as well. So to put us in that time, I think is a very different economic perspective and economic picture. But like I said, the financial press has done a really good job of driving those fears in the incline.
Well, I mean, we talk about this all the time here that, we're on a historic growth from an economic standpoint, 10 years now after '08. And so it's not a surprise to me when you get an inverted yield curve where you do have these fears. Now, as you're saying, they're blowing up in the press, but we're also, from an investor standpoint, the question is should we be skeptical?
Absolutely. And I think you've seen that. And you can look at a number of different metrics, whether it's assets in money market securities that continue to climb despite the recent market rally, whether it's investor sentiment. So the graphic that we're looking at now really graphs investor sentiment relative just to the broad S&P 500. And what you'll note is historically, and this goes back about 10 years, you'll note that investor sentiment and market activity tend to trend together a lot of time. And you can see in this chart that unfortunately, really over the last, call it 18 months or so, that investors have been real skeptical of the rally, rightfully so, in that there has been a heightened volatility in numerous times during those 18 months. But you can see this is the TD Ameritrade Investor Movement Index. And what it's telling you is really investors got skeptical really the beginning of 2018 and have not picked back up in terms of their enthusiasm around the markets.
Maybe one of the things we would see, Austin, in this would be maybe a move to cash where just investors are just on the sideline.
Absolutely. And hinted at it earlier, that this idea of money market assets, and we've continued to see that grow really over the last, call it 2 years, despite the broader market growing over that same time period. It's been a really interesting dynamic, as typically when markets are as strong as they have been, hitting all-time highs, investors are more prone to invest. But unfortunately, whether it be the headlines, whether it be politics, whether it be some of the volatility, you've really seen an investor that more often than not has almost remained on the sidelines.
And so I can view this as a positive, not necessarily a negative, in terms of when we look at sentiment, typically it's a counter indicator.
Absolutely. And I think that's an important point in that we get questions all the time of really what drives the market higher. Where's the next leg? And the idea that there's actually a lot of money still on the sidelines is something that's really important to consider as we look forward into 2020.
So, Scott, before we leave the U.S. economy and just the U.S. growth prospects, I mean, there is weakness in manufacturing numbers. There is weakness in terms of some of the economic numbers that we're seeing out from the financial press. How do we contextualize those with the cash that's on the sideline, where we are in the growth cycle? How do we contextualize all that?
Well, I mean, I think you're seeing it somewhat in a number like this, in that people with their money are a little bit hesitant. You know, they're not quite believing this is a great time to invest. even though like their personal lives are great, the personal lives they're pretty confident. Their political and investment lives they're nervous. They're polarized. They're nervous. They don't know. They kind of don't know up from down. And we see that in a chart like this, where we see this. Just to describe what this chart is, the red and green shaded areas is a measure of political polarization. So when it's red, that means political polarization is high. When it's green, it means political polarization is rather low in the United States. The blue line is a graph of consumer comfort. So it's just how's Main Street feeling? As opposed to the previous chart, which is kind of how is Wall Street feeling? How's individual investors on Wall Street feeling? And it's an interesting dichotomy. This graph shows that the political polarization is very high, and I don't think that's really probably a surprise to anybody listening to this, but it's kind of Bush Iraq war kind of levels. But look where consumer comfort is. Even relative to those levels, like in the mid 2000s, which was really a pretty reasonable time in the economy. High polarization and consumer comfort wasn't great. Right now, we have very high polarization, but we have really the consumers feeling great, and there's a lot of reasons why they should feel great. We got great jobs numbers this morning. We have retail sales that is still kind of off the charts. If you want a job, you got one. Wages are rising at the best rate they've had in years. So the consumer is actually feeling pretty strong.
So some of this, I feel like when you're listening to financial press, whether that's TV or print, you've got all of this recessionary talk. You've got a lot of uncertainty in regards to the political landscape, and the rhetoric is very negative. And then you've got this trade dynamic that has some uncertainty too. So this bombardment makes sense why individual investors at least would keep cash on the sideline, especially if you're polarized.
That's right, but it doesn't necessarily mean that you're not going to go out to dinner or go buy a new house or buy a new car. We're not the data that would be in line with those types of ideas, those types of purchases, those types of consumer decisions, all are showing out very strong.
And so when we look at the U.S. economy, it's about 70% consumer driven, very different from we're going to talk about China, but very different from that economy. We're looking at the underlying consumer. The underlying consumer is healthy, but maybe mentally kind of fried.
Yeah, look, they're just worn out, which you get, and I think you are seeing that in the investor kind of confidence surveys. People feel tired of this environment.
So we certainly have to start talking about 2020. I know it's a year away, but certainly every month that moves closer, obviously we're going to see more and hear more about the dynamic between Elizabeth Warren, Bernie Sanders, and certainly Trump. But I know you've got a dynamic here about what would the impact be to an Elizabeth Warren presidency.
Yeah, and so let me preface this by saying this is certainly far too early to really take a lot of analysis on Elizabeth Warren and what she may do, because quite frankly, the Democrats have a history of hating the front runner. If you go back over the last 4 or 5 election cycles where the incumbent was not Democrat and they were running primaries, the front runner at this time never was actually the ultimate nominee. That being said, Elizabeth Warren's policies are so important and so different that they certainly warrant some analysis and some attention, even though we are pretty early in the cycle. And it should be pretty clear from this chart that the things that she wants to do are fairly wide-reaching. And if she were to come into power, if she were to win the presidency, we believe that it's likely under a kind of a Democratic wave scenario, and so we'd have to assume that she'd be able to do many of these things that she's highlighting. The takeaways for your clients, takeaways for our practices are that broadly speaking, these would be all these policies. You think about what you want from a social standpoint, but from a market standpoint, they would be challenging. They'd be challenging from a multiple perspective. So they like to multiple on the market because it turns the U.S. more towards European socialism and Europe. And if all you have to do is look at multiples for socialist economies, and they are lower because those economies are fundamentally less flexible than those that hold capitalist sort of overarching philosophies. So multiples probably come down, and just looking at financials, looking at energy, looking at healthcare, looking at technology, the things that she wants to do would certainly be challenging towards earnings. So if you have an environment that is that puts downward pressure on multiples and downward pressures on earnings, probably doesn't take it's not rocket science to figure out that markets would probably be more challenged under her reign, at least initially, than under the current administration.
So when we talk about this is certainly not us calling Elizabeth Warren for the election in 2020, just saying certainly note and watch.
Right. But again, it is far too early to call something like this, but it could be so important that we feel it's at least relevant to start the conversation.
And when I was looking at this slide too, I just thought it was helpful to have it. So you might want to print this slide out, put it on your desktop, and just refer back to it. I think the one thing I was going to ask you, as you kind of go, as you look at this slide, it's massive in terms of the impact. Could you replace Elizabeth Warren in this slide with a Bernie Sanders, and the impact's pretty similar?
Yeah, I mean, either one of those would accomplish or want to accomplish much of the same things. We put Elizabeth Warren up here because she's the current front runner, but the policies are fairly interchangeable between her and Sanders.
So we're tracking in terms of 2020 and starting to track even at the policy level, and certainly from a market perspective, what impacts could look like even now. So we'll continue to update that as we get information. As we turn back to you, Austin, we're talking about U.S. foreign policy. So we talked about U.S. politics in regards to what may transpire in terms of not only the polarization of the U.S., but also I would say the polarization of policy. But one of the policies that certainly has been viewed probably by most people right now over the last year and a half has been this Chinese trade conversation, and certainly the policy over a pretty stringent policy in regards to IP, in regards to U.S. business and how it's conducted, not only in China but also how Chinese business is conducted here.
Absolutely, and I think it's been interesting, right, over the past call it 18 months now with the trade war that has kind of picked up steam. Is that it's really been this sense of almost deja vu, in that you feel like the cycle that we go through in regards to whether it be President Trump or another administration member coming out and maybe they're tough on China at the forefront. The market is obviously concerned about that. Then there's maybe hints of a resolution to which the market responds positively, but then you don't really see much progress, and we start the cycle all over again. I think you saw a perfect example of that in the third quarter coming out of, I guess, the G20 meeting there at the end of June. The U.S. and China really formally agreed to restart trade talks, which is a positive, right? Fast forward to the beginning of August, and you have President Trump come out and announce an additional set of tariffs following a couple days of talks where there really was no progress. Then you get retaliation from China. That's a halting of purchases of U.S. agricultural products. And again, it just starts to snowball in regards to that cycle. We've seen, as the quarter came to an end, a little bit more of a positive uptick on the news that trade talks are going to resume here in the month of October. But again, you've had so much uncertainty around the trade talks as a whole, and you really haven't seen a lot of substantial progress. I think that's really where the market uncertainty has lied over the past, call it 3 or even 6 months now. I think the other thing you have to keep in mind is the Chinese are really working internally to strengthen their economy in spite of the trade talks. So this next chart that we're showing here really looks at Chinese economic activity. So this is the China credit impulse chart. And again, really all that means, and really what we're watching for it, is an uptick in this means economic activity is picking up in China. And you started to see it really pick up at the end of last year, but you finally started to see that become positive, meaning that there's an expansionary feeling and there's an expansionary movement taking place and taking hold in the Chinese economy, really driven by some of the activity from their central bank. So that's definitely helping. And what you're seeing is really you're starting to see reinvestment in their economy. So I think that's important as we talk about the impact that a Chinese economy can have on the global economy. Obviously, there's been weakness. We referred to some of the manufacturing data earlier that we've seen, and some of the weakness there, and maybe the fears heading into the end of the year and into 2020. I think what you're seeing is as China starts to pick up their economic activity, that should be a boost just more broadly for the global economy, despite what's happening in some of the trade conversations that are taking place.
Does, as this thing progresses and in regards to the conversation that's unresolved in regards to whether there is going to be a trade agreement with China, we should note that in the third quarter you did have a Japanese trade agreement, which was actually very good for the U.S. What I would suggest is that as this continues to progress out, you would expect charts like this to look. It would be hard to predict how these charts would look.
No, absolutely, and I think that's where the market uncertainty lies. It's just the unknowns in terms of going forward around what those negotiations look like, and obviously the impact that has on the individual economy.
Hey, so thank you very much for that. I mean, certainly we went from the U.S. economy, talked about the yield curve inversion. We talked about the negative yielding assets across the world. We talked about recessionary fears, certainly U.S. politics and their dynamic between Elizabeth Warren and Bernie Sanders in regards to maybe the impact that would create from a market perspective, and then ended in regards to the Chinese tariff discussion and where that might take us. So that said, we have a questions tab in regards to webinars. Thank you for the questions that have already come in. There is a couple that I want to start with you, Austin, in regards to this international domestic investment thesis, because really global markets haven't done a whole lot in 18, 24 months. And if I'm an investor, right, I'm looking for returns. Certainly yields are down, as Scott brought in. Can I hope for this turnaround in terms of global markets providing me some return?
Absolutely, and that's a fair question. I think what you are seeing internationally is you're definitely seeing maybe pockets of opportunity, and that's where a manager that has a global flexible mandate where they can make shifts into and out of different regions or different countries, we would say is very important. I would say going forward, having a strategic long-term tilt towards a specific section of the global economy, be it domestic or international, can actually kind of keep you on your heels, in that you don't have the ability to move with the changing economy and the changing environment of the individual economies. I would say what we're looking to do is take advantage of opportunity where it exists, and that may change obviously as we go forward into the fourth quarter, into 2020. Given some of the uncertainty that exists today, you can't necessarily predict maybe what it's going to be a year from now, but there are areas where we see opportunity today that may not exist 3 months from now.
So, and I should have put this on the front end of that, in terms of we operate with 3 different categories. We operate with accumulation portfolios that we have called gain. We talk about preservation type solutions that we call protect. And certainly, if you're trying to solve for not running out of money, we call those simply spend. And those are obviously distribution solutions. You're talking primarily about gain solutions here in terms of allocation. So I just want to listen to what you're saying, which is you're going for flexibility over the specifics of a position. But certainly in this environment, I know we've been overweight domestics for some time now. Do you see that continuing?
Absolutely, yeah. I think the domestic overweight has been something that we've maintained here at Horizon for, call it, almost 2 years. And I think that is an area where we see the most certainty on a relative basis currently. But again, that's something that there are many things that could change.
Well, and you and I talk about, and Scott, we talk about not zeroing out the international position. That's just as difficult as overweighting it at this point, just because of the amount of uncertainty.
Yeah, absolutely. And I would say If you look forward and say a trade deal does get done, I think that's an area where international stocks do have room to run as you head into 2020.
So, Scott, I want to come back to you. There's a question which I think is a really good one, because you have all this negative news in regards to recession. You have this polarization of the electorate, and certainly you've got uncertainty, if nothing else, in regards to the trade dynamic or whether U.S. politics in regards to impeachment. And so the question I think that comes up is this idea of how possible is it to repeat the fourth quarter of last year? We had a pretty dismal quarter in the context of this idea of gain or accumulate, protect and preserve, or spend and distribute. In that context, is it possible to repeat, or how possible is it to repeat the fourth quarter of last year?
Yeah, I mean, look, we'd say it's certainly possible, because we do live in a world right now where liquidity conditions are not as good as they've been, previously. So it is possible to get sharper moves, especially in equity markets, than we have been used to over the last number of years. But there are two really important differences between right now and October of 2018. One of those is, like, think about what the Fed was doing in October of 2018. They were still hiking. They were still very hawkish. The language was very confusing out of Powell. And think about it, fast forward a year to what they're doing right now. That we're in the middle of an easing cycle. They're consistently dovish in their communication, and it's fairly clear. They're being consistent. So the Fed backdrop, first and foremost, is really starkly different than it was a year ago this time. So that's one important distinction, and that was a big worry, if you remember, last fourth quarter. The second one is a little bit more nuanced and probably a little bit more complicated, but I'll refer to it, and happy to take further questions from clients if you have specifics on this. But there is this aspect of investor positioning, especially with respect to systematic strategies that we follow, things like trend following and risk parity and global macro investors and long short hedge funds. Those types of things, those types of investors, those types of strategies, you can measure the impact of what they have to do, kind of forced selling, forced buying. Last year, they were a little bit stretched to the long side. In other words, they were levered up a bit. This year, totally the opposite. They're actually underinvested right now in equities. So the selling that would come from strategies like that really doesn't exist. They actually are buyers of dips, and buyers as things go down right now, the way they're set up and the way they work. So those two things, the Fed being starkly different, basically 180 degrees different than they were last year, and systematic strategy kind of setups and positioning being 180 degrees different than they were last year, would probably make me say it's not as likely to have a repeat like that.
So you're saying professional investors, at least in that instance, are aligned with individual investors that might be hoarding some cash here, that actually would provide a cushion to markets.
Institutional investors are almost universally underinvested right now.
So when we talk about risk management strategies, one of the things I wanted to ask you, because certainly our protect category is inclusive of low volatility that we run. Certainly we run risk assist, which is a de-risking algorithm, and then certainly our collar strategies. And what I would say is, what's interesting about this market environment is that low volatility investing, or the low vol factor, has really been in favor in this time. And from a collar strategy or from a risk assist strategy, they're doing what they should be doing. Why has low volatility investing been in favor?
It's been interesting. It's a similar dynamic to what we had coming out of 2015 into 2016, when low volatility was similarly in favor. You have a fairly low rate environment, and so that pushes people generally out the risk spectrum in terms of like making equities more attractive. But if you're a bond investor having to go to equities, where are you going to go? You're generally going to go to the more defensive, lower volatility / lower risk types of equities. And that has certainly provided somewhat of a bid to, or kind of undergirding towards, the low volatility factor and low volatility equities overall.
But what I hear you also saying on the other side is that there's this drag in regards to what's taking place in the market. So if you have trade uncertainty come off, or you have presidential uncertainty come off, if you have some of these things come off, do you think the market is poised, especially with all the cash on the sideline, you think the market is poised for a pretty decent rally.
I mean, listen, everybody's underinvested. And like you said, Robbie, if we get some certainty around these things, which have been just structurally uncertain for what seems like my entire life, it's just been forever. Then yeah, we're going to see a rip, and it's going to be it will be led by international stocks because the dollar's going to drop. But it is going to be a very fast rally in global equities.
Well, and it doesn't surprise me if that does happen, that individual investors are underweight equities because of studies like Dalbar that says that they don't return what investments return, and primarily it's because of just bad timing. So Austin, I've got one final question that comes in that I just think this is the most practical question that you could ask us. So I'll ask both you and Scott the same question. All right, so all of what we've talked about, what would you tell an investor to do with $1 million?
Yeah, absolutely fair question. And like you said, I think very practical given kind of where we sit. I think the way that I would look at that and the way that I would phrase that, especially from the light or from the lens of a financial planner, is first and foremost, you have to have a drawn out plan for those assets. So whether it's, as Robbie mentioned earlier, whether the goal or the objective is to grow the assets, whether the objective is to protect the assets or distribute or spend the assets, I think that is paramount to get set out at the beginning. But to that extent, I think it's really important because a lot of folks, and we've all talked about it, where the wealth concentrates in that baby boomer generation, really focused on nearing retirement, beginning to think about taking distributions, but they're really in that protect phase. And that's where I would tell you, Robbie, that the products that we have and the ability to really invest in a solution that has maybe some downside protection, given so much uncertainty that's in the market today, can be very valuable to a client. The ability to have some risk mitigation in place to reduce that volatility, I think is an area where clients appreciate, but also the ability to capture as much of the upside as they can if and when markets do rally.
I appreciate that. I am also curious, Scott, your opinion. Same question. Individual investor comes to one of our advisors and has $1 million. You're sitting there and the advisor turns to you and says, what would you do?
Get in the game. Seriously, do you want to be investing when everybody else is already invested? Or you want to be investing when professionals are underinvested, retail people hate stocks and are underinvested, per either money market data or just by survey data. Just get involved and get in the game. This is actually a pretty attractive time to invest, given the backdrop of everything that we're seeing. Everybody knows all the negative stuff. Like everybody knows that the China trade negotiations have been challenging. Everybody knows that European growth has been slowing down. Everybody knows that manufacturing in the United States is troubling right now. Everybody knows all this stuff already, and that's why everybody's scared, and that's why everybody's nervous, and that's why everybody's underinvested. Everybody knows it. They're positioned there. So if you want to be smart with the clients and be smart with how you're advising them, tell them to get in the game. And if they're super scared and they don't want to, they're just not ready to listen yet, then do what Austin was saying. Like enter into something with some sort of protection, whether it's a low volatility strategy or a collar strategy or a risk assist or anything like that. Like get them there somehow, but get them there.
And I think when we talk about distribution clients, what we are concerned with certainly is this idea of creating too conservative of a portfolio where, if they're trying to solve for not running out of money, certainly, Austin, we've seen it where maybe if they're a 3-bucket strategy and the investment bucket is just oriented too conservatively, you will mathematically run out of money quicker than if you're doing what Scott is saying, which is getting in the game, at least dabbling in equities in that bucket.
Yeah, you have to have that growth engine to drive future income for those distribution clients. I think that's a great point, Robbie, that you really have to be invested appropriately in that portion of whether, depending on what strategy you're using, what bucket type of strategy, but you have to have an investment bucket that is really driving those future distributions for those clients. And if you don't, what you'll find is client that's underinvested in that bucket, oftentimes you'll run out of money much quicker than probably the client even needs.
Well, I knew it wasn't a fair question for both of you. We don't have one-dimensional clients. We don't have one-dimensional advisors, and certainly these questions are complex. And a lot of times, the individuals have multiple goals that they're trying to achieve, not one goal. And so you might have goals that are they're trying to accumulate, and some goals that they're trying to preserve, and others certainly that they're trying to solve for not running out of money. So in that game, typically the solution is kind of all of the above in regards to how we've set up to try to undergird what the advisor does. Again, if you're new to us, our mission is to empower advisors to help their clients reach their financial objectives. This isn't the end of the conversation. It's literally just part of the ongoing conversation that we have with our advisors. If you have any questions or you just want to interact in regards to something we've said, please reach out to our sales desk. They'd be happy to take that, and certainly you can get in touch with one of us at 866-371-2399 or at sales@horizoninvestments.com. This is the third quarter. We really look forward to reaching out to you at the beginning of next year, at the end of the fourth quarter, to kind of do the recap of 2019 and look into 2020. I get really excited when we start looking forward, especially in an election year. All kinds of things are going to be interesting and can happen, and we look forward to being in front of you. Thank you very much for you joining us, and thank you again for choosing Horizon Investments.